Welcome back to the Pro Ticker podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Good morning. We've got quite a stack here today, yeah. Articles, reports, looks like June 4th, 5th are the key dates.
Exactly. We're digging into all of it: markets, economic data, policy changes, even personal finance trends.
And the goal, as always, is to sort of unpack this, right? Find the important takeaways.
That's it. Understand what it all means for the landscape right now and really how it connects back to you.
Okay, sounds good. Where are we starting?
Let's kick off with the U.S. economy and markets, because looking through these sources, the picture seems pretty mixed.
Yeah, mixed is a good word for it. If you look at Wednesday, June 4th, stocks were all over the place.
Right. The Dow actually broke its winning streak.
It did. Snapped a four-day run, fell just a bit, 0.22%. Closed at 4.74 to 7.74.
Okay, a small dip there. But the S&P 500?
Basically flat. Up a tiny fraction, 0.01% to 5,970.81.
And the NASDAQ, tech-heavy index.
That one saw a small gain, up 0.32%, ending at 19,460.49. So, yeah, definitely not moving in lockstep.
So what was driving that divergence? These reports point to some key economic data points.
Definitely. First up was the ADP private payrolls report for May.
Yeah.
And it was weak.
How weak are we talking?
Really weak. Only 37,000 jobs added, according to ADP. The forecast was, what, around 110,000?
That's a big miss.
Huge miss. And it's the lowest number they've reported since March 2023. Plus, they revised April down, too, to 60,000.
Now, the sources always caution, ADP isn't a perfect crystal ball for the official Labor Department numbers.
True, there could be differences. But still, a number that low definitely suggests the labor market might be, slackening a bit, slowing down.
Okay, so weak private jobs data. What else? The Fed's Beige Book also came out.
Right, the Beige Book, which is based on sort of anecdotal evidence, right? Interviews, questionnaires across the Fed districts.
And what did it say?
It indicated that economic activity had actually declined slightly since the last report back in late April.
Declined slightly, okay.
Yeah, and it specifically mentioned slowing hiring. And businesses and consumers were apparently expressing concerns about potential price hikes linked to, well, tariffs.
So, weak jobs data, Fed hearing about a slight slowdown, and tariff worries. How did the bond market take all this? Treasury yields.
They reacted pretty quickly on Wednesday. Yields dropped quite sharply. The 10-year yield, for example, eased by more than 10 basis points.
And where did they settle by Thursday morning?
Things stabilized a little. The 2-year was around 3.885%, the 10-year at 4.371%, and the 30-year was sitting at 4.89%.
So yields falling typically signals worries about growth, maybe expectations of lower rates down the line?
That's the usual interpretation, yeah. Flight to safety or anticipation of Fed action if the economy cools too much.
Okay, so data suggesting some softness. What about business sentiment? How are executives feeling?
Yeah, one of these sources has a survey from the Association of International Certified Professional Accountants, and it's pretty stark.
Stark how? Optimism down.
Plummeted is the word they used. In the first half of 2025, optimism just fell off a cliff, basically.
Give us the numbers.
Okay, so in May, only 27% of executives polled felt confident about the economic outlook for the next 12 months.
27%, wow. Compared to
47% in the first quarter of this year. And get this, it was 67% right after the U.S. vote late last year.
Whoa. From two-thirds confidence down to almost one quarter in, 6 months? That's fast.
Incredibly fast. And the survey says many execs are now, revising their expectations down, delaying hiring, delaying investment, pulling back on expansion plans.
Makes sense if they're feeling less confident. Did the survey touch on recession odds?
It did. 1 in 5, so 20% of these executives believe the U.S. is already in a recession.
Already in one?
And another 34% expect a recession by the end of this year.
So over half expect one either now or by year end.
Right. And of those expecting one, 3/4 think it'll be moderate to severe. So not just a mild dip in their view.
Okay, so significant pessimism from business leaders in that survey. But I think I saw a note about Deutsche Bank having a slightly different take.
You did. Good catch. Deutsche Bank analysts looking at the same weak data points basically said, hold on, these numbers aren't so bad that they revive immediate recession fears.
So even the experts disagree on the interpretation.
Exactly. It really highlights the uncertainty. Same data, different conclusions about the immediate risk.
Okay, let's pause there for a second. Why does all this U.S. data matter to you, our listener?
Well, it's because these conflicting signals, slowdown warnings here, less concern there, They create uncertainty.
And that uncertainty impacts everything, right? Your job prospects, market stability.
Absolutely. It affects your investments, your 401k, how you plan financially. It's the backdrop for everything. It's a really complex, shifting picture right now.
Okay, let's widen the lens then. Take a look around the globe. What were markets doing internationally based on reports like the CNBC Asia one?
Also a mixed picture, unsurprisingly. On Thursday, June 5th, Asia-Pacific markets were varied.
Any standouts?
South Korea's Kospi had a strong day, up almost 1.5%, hit a 10-month high. Seems like continued optimism after their election.
And analysts are bullish there.
Yeah, one source mentions Nomura expecting the Kospi to hit 2,900 by year-end. They're banking on capital market reforms and expansionary fiscal policy under the new president.
Okay, strong Korea. What about other major markets? Japan.
And Dan was down. Nikkei at 225 fell about 0.5%. Topics lost ground too. Australia's S&P SX 200 was basically flat.
But some gains elsewhere. China? India?
Yep. Hong Kong's Hang Seng was up about 0.85%. Mainland China's CSI 300 saw a smaller gain, 0.23%. And India's benchmarks, the Nifty 50 and Sensex, both added around 0.8%.
And India might see a rate cut soon.
That's the expectation mentioned in one report, yeah. The Reserve Bank of India is expected to cut its benchmark rate. That would be significant.
Okay, beyond the indexes, what about specific company or sector news popping up in these global reports? Technology is always key.
Right. Asian tech giants seem to follow Wall Street's lead, extending gains. Think SK Hynix, Samsung in Korea, Advantest, Renesas in Japan, all up.
TSMC Foxconn.
Muted gains there in Taiwan. Hong Kong's tech index was up too. Names like Kuaishou, SenseTime, Meituan, Alibaba saw movement.
So generally positive for Asian tech, mirroring the U.S.?
Mostly. SoftBank in Japan was mixed, but yeah, a generally positive vibe.
Now let's shift to something completely different. Steelmakers. The U.S. just doubled tariffs on steel and aluminum imports to 50%. Huge hike. How did Asian steel stocks react?
This is interesting. You'd expect them to fall, right? But mostly they rose on Thursday in Asia Pacific.
Rose, despite the huge U.S. tariff increase.
Yeah. Chinese state firms like Angang Steel, Manshan Iron and Steel were up. South Korea's POSCO Holdings actually surged.
Any losers?
A couple of Japanese firms dipped slightly, like Osaka Steel. But Indian companies like Jindal Steel, JSW Steel were up. Tata Steel was flat. So not the reaction you might instinctively predict. Maybe other factors were at play or the market priced it in differently.
Fascinating. Okay, let's talk about electric vehicles in China. These reports describe a brutal price war, using the term involution.
Yeah, involution, or Neiwan. It describes this intense kind of race to the bottom competition. The EV price war there is apparently incredibly fierce.
So fierce that regulators stepped in.
They did.
Yeah.
Chinese officials actually called in the heads of major EV companies, including giants like BYD, just this week.
And the message was?
Basically, self-regulate. Stop selling cars below cost. Stop offering unreasonable discounts. The sources say it's pretty rare for regulators to hold a meeting specifically about pricing like this.
And it's not just regulators. Industry groups, state media.
Everyone's piling on. The China Automobile Manufacturers Association called it a vicious cycle, threatening the supply chain and profits. State media outlets are urging companies to stop discounting, worrying it damages the Made in China brand image, making it about cheapness, not quality.
But are analysts convinced this pressure will actually stop the price war?
Mostly, no. The reports suggest analysts are skeptical. Some think it'll get even more intense until there's consolidation and weaker players just fold.
Any sense of stress in the market?
They mention signs of oversupply, like falling export prices for Chinese EVs going to places like Germany, and this phenomenon of zero-mileage secondhand cars.
Zero-mileage cars? What's that?
Basically, brand new cars registered as sold by the maker, then immediately flipped onto the used market. It can kind of inflate sales numbers and points to maybe too much inventory.
And one CEO called this just an appetizer.
Yeah. XPeng CEO. So the real competition will be on technology, not just price cuts. But clearly the price pressure is intense right now.
Are these EV companies making money in this environment?
It's tough. XPeng, NIO, still reporting losses in Q1, according to these sources. But Xiaomi, the big electronics firm that jumped into EVs, thinks their EV business could turn a profit in the second half of the year. So a real mix.
Okay, shifting again. Gaming Nintendo shares dipped?
They did, down almost 2% after the global launch of the Switch 2. It's got new features, bigger screen, better graphics, but it's also their most expensive console ever at $449.99.
And they're aiming to sell 15 million units. Market seems hesitant initially.
Seems so.
What about banking and finance globally? Any big moves?
Citi announced plans to cut about 3,500 tech jobs in China, Shanghai and Dalian by Q4, part of their global cost-cutting efforts.
And JP Morgan sees opportunity in Asia.
Big time. Specifically in the private credit market in Asia-Pacific, they're targeting mid-sized companies that don't necessarily have investment-grade ratings.
Why the focus there?
Well, Asia's driving over half of global GDP growth. But the private credit market there, around $200 billion a year, is still pretty small compared to the public debt market, which is like $1.5 trillion. JP Morgan sees a big gap, big potential for growth.
Got it. Let's quickly hit the UK-specific news mentioned, an inflation data correction.
Yeah, a minor but important one. The ONS said they overstated April inflation by 0.1 percentage points due to a car tax data error. The revised rate is 3.4%, not 3.5%.
Okay. And that Bank of England survey about how UK firms see U.S. tariffs.
Really interesting. Basically, British firms are shrugging them off. Only 12% called U.S. tariffs a top 3 uncertainty source, down from 22%. Most expect no impact on sales, prices, or investment.
So for the Bank of England, it's more about domestic issues?
Exactly. The survey also showed wage and price expectations cooling slightly, suggesting domestic factors are much more important for future UK rate decisions than U.S. trade policy.
And finally, Wise, the payments company, potentially moving its main listing.
Yeah, Wise Pellic is planning to shift its primary listing to the U.S. The sources frame it as another blow to London's market, citing things like lower valuations and less liquidity compared to the U.S.
And Wise thinks a U.S. listing is better for them.
They see the U.S. as their biggest market, expect benefits like more liquidity, maybe getting into U.S. indexes. They'll keep a U.K. listing too, though. CEO's voting control was also mentioned.
Okay, so stepping back from all that global detail,
Yeah.
what's the takeaway for you, the listener?
It's that all these things are connected. Asian market moves, trade policy hitting steel or EVs, big companies shifting strategy. It affects supply chains, the price of things you buy, maybe your job, and definitely investment opportunities outside your home market.
Right. It's a global web, and these are some of the threads being pulled right now.
Precisely. Understanding these global dynamics gives you crucial context.
Let's move now to the really big picture stuff. Major policy trends, macro forces shaping the whole landscape. Tariffs keep coming up.
They really do. We mentioned the steel aluminum ones. But there's talk in these sources about potentially much more drastic tariffs aimed at Russia.
This is the Senate bill.
Yeah, championed by Senator Lindsey Graham, reportedly. It proposes a 500% tariff on Russian energy, imports oil, gas, uranium, petrochemicals, basically a ban.
500%. Wow.
But here's the kicker. It wouldn't just hit Russia. It would also slap that same 500% tariff on exports to the U.S. from other countries. China, India, South Korea, Turkey are mentioned if they keep buying Russian energy.
So it's designed to force everyone to cut off Russian energy to punish Russia for the war.
That's the clear analysis presented. Force global disengagement.
But what are the potential downsides?
Big ones, according to analysts cited. Sanctions on that scale could really spike global energy prices, which would hit the U.S. economy, hit consumers hard. It's seen as a very high-risk, potentially very disruptive move.
And this is different from the previous administration's approach.
Very different. The sources note former President Biden used a price cap mechanism specifically to keep Russian oil flowing to avoid those price spikes. This proposed bill is far more aggressive.
Any sense of where the current White House stands?
One report suggests they might prefer to delay dealing with these Senate sanctions, maybe until after other legislation like the tax bill gets sorted. There's just maybe some reluctance to embrace this strategy right now.
And remember, the UK survey showed firms that aren't too worried about current U.S. tariffs.
Right. Shows how impacts vary. And we also saw the flip side. China's rare earth curbs, described as a response to earlier U.S. tariffs, are now apparently causing shutdowns in the European auto supply chain.
Because European companies can't get export licenses from China for those crucial materials.
Exactly. A direct ripple effect of trade tensions hitting production lines.
Okay, switching gears within U.S. policy, there's a lot of focus in these sources on U.S. government debt, serious concerns being raised.
Yeah, one opinion piece really goes after a House-passed tax bill, calling it the one big, beautiful bill, and arguing it could push U.S. debt over the edge.
Strong words. What are the numbers they're using?
The analysis says the House version adds about $2.5 trillion to the debt over 10 years, before interest. But critically, if temporary tax breaks and it get extended, which they argue usually happens,
Right, history suggests they often do.
then the cost could jump to around $5.3 trillion over the decade, according to the Committee for a Responsible Federal Budget.
$5.3 trillion added debt. What does that do to the overall picture, the debt to GDP ratio?
The argument is it could push the debt to GDP ratio over 200% by 2055. It's currently around 121%. The piece dismisses the idea of just growing our way out of it as a dangerous delusion, pointing to the long-term trend since '93 of the ratio just climbing higher.
And the piece criticizes the timing of this potential debt increase, too.
Heavily. Argues it's reckless because the economy isn't in a deep crisis needing massive stimulus. Instead, we face inflation risks, geopolitical uncertainty, terrorist chaos. There's no compelling economic reason, they argue, to add trillions in debt now.
Does it say anything about what is being funded or cut?
Yeah, it critiques the bill for cutting nearly $1 trillion from strategic investments, things like healthcare, food aid, clean energy incentives, innovation funding, things that might actually boost long-term growth. So the conclusion drawn is it's the worst of both worlds. More debt, less growth-focused investment.
So are the financial markets worried about this debt trajectory? Bond markets signaling anything?
Yes, definitely. The sources say bond markets are showing concern. We're seeing long-term Treasury yields rise, not fall. There's been a sell-off in long-term bonds. The term premium, the extra yield investors demand for holding long bonds, is going up.
Which signals?
Fears of higher inflation, higher government borrowing costs down the road. It's not a sign of confidence.
And the credit rating agencies have all downgraded the U.S. now.
That's right. Moody's, Fitch, S&P, all three have downgraded the U.S. credit rating at this point. They see the government as a riskier bet, partly due to this fiscal outlook.
There's talk of a potential vicious cycle. Can you explain that?
Sure. It's a dangerous feedback loop. Bigger deficits mean the government borrows more. More borrowing pushes interest rates up. Higher rates make servicing the existing debt and issuing new debt more expensive. That increases the deficit further, pushing rates higher still. You see the cycle?
And that could eventually tie the Fed's hands or force really tough choices.
Exactly. It could limit the Fed's ability to manage the economy and might force painful decisions later, big tax hikes, deep spending cuts, or risk a fiscal crisis. The CBO already projects a tipping point around 2044. This argument is that the tax bill could bring that date closer.
And how does this potentially hit ordinary Americans, the average person?
The argument is pretty direct. Rising interest rates mean higher payments for you on mortgages, car loans, credit cards. Program cuts could mean lost jobs or services. And the analysis cited, using Penn Wharton data, suggests the tax benefits skew heavily towards the wealthy, while the costs, higher rates, potential future austerity fall disproportionately on lower and middle incomes.
Ray Dalio also weighed in on the debt situation.
He did, called the U.S. debt situation urgent. He warned against trying to lower interest rates unnaturally, saying, basically, you can't print your way to prosperity. Higher yields mean higher government payments. Simple as that.
His advice for investors:
Diversify. De-emphasize debt assets in this environment. He specifically mentioned holding 10–15% in gold as a good diversifier. And yeah, he's promoting a book called How Countries Go Broke. Tells you his mindset.
Speaking of gold, central banks are buying a lot of it, right?
Massive amounts. On track for a fourth straight year of huge purchases, maybe 1,000 metric tons in 2025. It's about diversifying away from the U.S. dollar.
And the drivers for that de-dollarization.
Several things mentioned. President Trump's unpredictable policies and Fed criticism, the worsening U.S. fiscal outlook eroding confidence in the dollar and treasuries, plus general geopolitical tensions making countries nervous about relying solely on dollar assets.
And gold prices reflect this.
Big time. Up 29% this year, hit a record $3,500 an ounce in April. Central banks are now the third biggest gold consumers. Jewelry demand is actually down a bit because prices are so high. Analysts expect prices to stay high, maybe rise even more into 2026.
Okay, quickly, we need to cover a couple of other U.S. political actions mentioned in the sources, neutrally just reporting what they say. First, a travel ban.
Right. The Trump administration signed a proclamation suspending travel from 12 countries, partially restricting 7 others.
The stated reason:
national security. The proclamation says those countries lack adequate vetting processes to screen for potential threats.
And this is the third one, facing opposition.
Correct. Third, under this administration, and Democratic lawmakers are reportedly opposing it.
And the other item, an investigation into former President Biden's final actions.
Yes. President Trump directed an investigation alleging aides might have masked pardons or used an autopin without Biden's full knowledge, calling it a dangerous and concerning scandal.
What context do the sources provide?
They note open use is a long-standing practice across administrations, and that no evidence was presented that Biden was unaware of the actions taken.
And House Republicans are pursuing this too.
Yes, requesting interviews with 5 former Biden aides alleging a cover-up and questioning Biden's cognitive state, who was calling the shots. Democrats call it a distraction. The inquiry focuses on the validity of Biden's final executive actions.
Okay, so pulling this whole policy section together for the listener, what's the bottom line?
These huge policy debates, tariffs, trade, government debt, spending, they set the stage for everything else in the economy.
They directly impact inflation, interest rates.
Exactly. Your cost of living, your ability to borrow money, how your investments perform. These big picture forces shape the financial landscape you live in. Understanding them is key.
Absolutely. Okay, let's bring it right back home now. Let's talk about retirement savings. Using that recent Fidelity data, this is super relevant for pretty much everyone.
For sure. And the headline from Fidelity for Q1 2025, 401k millionaires actually got rarer.
The number dropped.
It did. Fell to 512,000, down 4.6% from the end of 2024. The median balance for that group was $1.3 million.
And the reason for the dip?
Straight up market weakness in Q1.
Yeah.
The S&P 500 fell 4.3%, remember. Sources link it to that uncertainty around tariffs, economic weakness fears, just a general market correction pulling things down.
So the market dip hit those top accounts. What about the average Joe, the average and median balances?
Also affected, but maybe less dramatically on average. The average 401k balance was $127,100. That's down 3% from Q4 2024, but actually still up 1% compared to a year ago.
And the median always paints a different picture.
Much lower. Median 401k was $29,800. Shows how averages can be skewed by the high balances.
Can we break it down by generation, baby boomers versus millennials, etc.?
Yep, Fidelity provided that. Average 401k for boomers, $239,600. Gen X, $187,400. Millennials, $66,800. And Gen Z, just starting out, $13,900 average.
What about IRAs and 403Bs?
Similar trend. Average IRA, $121,943. So balances dipped quarter on quarter due to the market, but year-over-year changes were mixed.
But here's the really positive part, right? Despite the market dip, people's savings behavior was strong.
This is the key takeaway, I think.
Yeah.
The actual savings rate in 401ks hit its highest level ever recorded in Q1, 14.3%.
14.3%. That includes employee and employer contributions.
Correct. Employee average was 9.5%, employer 4.8%. That total is just shy of Fidelity's recommended 15% target. Really impressive given the market volatility.
Were IRA contributions up too?
They were. Average IRA contribution rose to $3,231 from about $3,100 a year ago. And baby boomers really stepped up, increasing their contributions by 21% on average.
What do the Fidelity experts make of this? People saving more even when markets are shaky.
They find it very encouraging. People like Sharon Brovelli, Mike Shamrell at Fidelity, said it shows a continuous savings approach, focusing on long-term goals. It helps people weather any type of market turmoil.
The whole marathon, not a sprint idea.
Exactly. They feel people get that now, maybe more than before. Access to information helps younger savers, while older savers have the benefit of experience, having seen ups and downs before. They aren't panic selling, they're actually saving more.
Did Fidelity see more people contacting them during the Q1 volatility?
Yes, engagement was up, website, phone calls. The common question was basically, should I be doing something different right now?
And Fidelity's advice?
Think long term. Stick to your plan. Don't make rash decisions based on short-term noise.
The data also mentioned 401k loans. Any trends there?
A slight increase in the percentage of people with an outstanding loan, up to 18.8% from 17.8% a year ago. But that's still lower than it was, say, a decade ago when it was around 20%. The rate of people taking out new loans was pretty much flat.
And Fidelity's take on loans discouraged them.
More pragmatic. Mike Shamrell said, life happens, financial emergencies come out of the woodwork, which is why they stress having separate emergency savings. The 401k loan is there, but ideally not your first resort.
Okay, so for you, the listener, this retirement section is really direct. Market dips happen. They affect your balance short term. That's normal.
But the big lesson from this data is the power of staying consistent. That marathon mindset. Seeing others stick with it, even increase savings, is proof that a long-term approach works and is widely practiced.
And that loan data is a great reminder about emergency funds, right? Having cash set aside is crucial so you don't have to raid your retirement savings when unexpected things happen.
Absolutely critical piece of the puzzle.
Okay, let's try to tie all these threads together now.
Yeah.
We've gone from mixed U.S. economic signals and market reactions
To global uncertainty driven by tariffs and geopolitics, affecting specific sectors like steel and EVs.
to the huge policy debates in the U.S. about debt, spending, and trade, alongside central banks globally buying gold.
And finally, back to how individuals are navigating it all with their retirement savings, showing real resilience and long-term focus.
Some definite aha moments stood out, I think. The way Asian steel markets reacted or didn't react to U.S. tariffs, the sheer intensity of that China EV price war.
Yeah, and the stark warnings about U.S. debt contrasted with the record-high personal savings rates. It shows these complex, sometimes contradictory forces at play.
It really paints a picture of an interconnected but also very uncertain global economic environment right now.
Dynamic is the word. Things are definitely moving.
So here's a final thought to leave you with, based purely on what we've discussed from these sources today. Given this combination of ongoing policy uncertainty, tariffs, the debt debate, the mixed economic signals we're getting, and that clear individual focus on long-term financial goals we saw in the savings data, what does this suggest about the importance of understanding those big global macro trends versus just focusing laser-like on your own personal financial fundamentals? Something to chew on.
A great question to ponder.
And with that, we'll see you all tomorrow morning with new headlines from major financial magazines.